Great. So we're very pleased to have you with us for a discussion on the current US real estate market. We're going to focus on capital markets, investor perspectives, multifamily, and the office sector. Before we begin, let me introduce today's speakers and the topics we'll be covering. So Trent Niederberger is a managing director at JLL Capital Markets in Chicago. Trent focuses on real estate financing and capital markets. He'll open the discussion with an overview of the current financing environment, including lending conditions, interest rates, the Fed policy, and where capital markets are heading. Mor Ziv from JLL Israel works closely with Israeli institutional investors, family offices, investing in cross-border real estate. Mor will share insights into how Israeli capital is currently approaching the US market, including data on investor activity and preferred sectors. Dave Gaines is a managing director and private capital group leader at JLL Capital Markets based in Chicago. Dave will focus on the US multifamily market, covering current fundamentals, market dynamics, why investors are viewing multifamily as an increasingly opportunistic sector today. My name is Uri Zror from Buligo Capital. I'll close the presentations with a discussion on the US office real estate market, how we think about the sector today, what has changed, and where we see both risk and opportunity. And with that, let's get started. Trent, I'll turn it over to you. You can share your screen. Oh, and I will mention that if you have questions, you feel free to put them in the chat, and we'll answer it later on. Great.
Good afternoon. Well, it's morning here in the United States. I know it's afternoon there. Can everybody hear me okay?
Yep, perfect.
And I'm sharing my screen. You should see U.S. Capital Markets overview, JLL Capital Markets. Is that?
Yep.
That's working?
Yep.
Great. Myself, as already mentioned, I've been at JLL for over 25 years. I specialize in sourcing debt and placing equity for U.S. assets for commercial real estate. My colleague Dave Gaines and I are going to present overview of what's happening now in U.S. capital markets, really focusing on the opportunity that we see over the coming 2-3 years. We will have a little bit of a discussion of how we got here and what's happened over the last 4 or 5 years, but more of the focus today and this morning is where we are, how we got here, and more importantly, where we're going. I'm going to turn it over to my colleague Dave Gaines, who's going to discuss kind of the This is our page. This is our page showing the overviews of what's going on, of what's occurring now in the United States.
Great, Buligo team. Thanks for having us. I'm David Gaines. I sit in Chicago, and I lead the private capital group for U.S. capital markets. A lot of time is spent on disposition of property and locating acquisition targets for groups like yourself. So I won't belabor the meaning by going over every box in this slide. There's a lot of great information here, but we are in a transition from a frozen market to a functioning market again. The debt markets are strong, large loans are back, and lenders are competing. That matters because liquidity drives transaction volume and pricing confidence. M&A platform activity is increasing, which tells us that large, sophisticated capital is moving again, and relative value favors commercial real estate because value is already reset, while many other asset classes remain expensive. Borrowing costs have come down, GDP expectations are improving, and the bid-ask gap is narrowing as well. That combination typically signals the early stage of a new transition cycle. So on the lagging side, core capital is not fully back, rent growth is uneven, construction is still challenged, and policy uncertainty remains. But this is actually typical of an early cycle environment. Not everything is perfect yet, which means we are not late, we are early. So the key takeaway here should be that more indicators are turning positive than negative, which is characteristic of the beginning of an upcycle.
So to to continue with Dave's point that we're at the beginning of an upcycle, this is a chart that shows the relative growth over the last 5 years or 6 years of the S&P 500 against commercial real estate values. As you can see, there's an overheating in the S&P 500 that's currently going on. We're at a 75% higher than, we're 75% higher than the peak. We're 13%, excuse me. Previous peak was 13%. We're 75% higher than early 2022, whereas commercial real estate values really had their reset and reprice in 22 and 23. Those prices are down 25 to 30%. But over the last year and a half, we're starting to see yields compress. So the point is that there's good value here as opposed to alternative investments, which are still expensive. A second factor that we believe is starting to push us into a new era, or not a new era, but a new shift, is the volatility expected with U.S. Treasuries and our GDP and the U.S. GDP forecasts. You'll see as the brown line in this chart shows the volatility expected by investors and the U.S. Treasury over time. It's on a downward trend. We're expecting interest rates will not probably go as low as they were pre-COVID. They are expected to stabilize as opposed to the volatility in the past. That brings us to debt market themes. For the transactions that are going to happen, you need both debt and equity. And there has been a large, significant amount of debt raised and ready to deploy in commercial real estate. Here's an overview of the financing market. There is no lack of capital. One of the things that drives commercial lending is what lenders perceive as alternative investments. And so, for example, life companies and banks have other things that they can invest in. Commercial real estate is very attractive to them. Life companies, for example, will, if you see in the right-hand corner, it says corporate bond spreads are near 35-year lows. Life insurance companies, for example, when they lend on commercial real estate, will want to trade on real estate at a premium of about 25 to 50 basis points above where the AAA bond or the BBB bond trades. And what we're seeing now is that those spreads have compressed, which makes real estate spreads compress. So there's a lot of early in the morning here. There's a lot of capital that's been raised. It's very attractively priced, and the outlook is that there's going to be more lenders than borrowers, and we anticipate credit availability to exceed borrower demand. This is a great slide that shows, where we were, where we are, and where we're headed. The very bottom, you have 2018. We consider 2018, 2019 a baseline, a little bit more of what has been normal. We had COVID in 2020, and then out of COVID, we moved into a real boom where people got back into business. Interest rates began to raise significantly, and we had a trough over the last 2 years, and currently we're headed back to a spot where there's a real opportunity. You can see in 2018, the Treasury was 275 versus against today's 5-year Treasury of 385. Commercial real estate spreads in 2018 were 120 to 150 basis points above the Treasury at that point, which created a fixed rate 5-year debt of between 4 and 4.25, roughly. That's kind of the baseline where we expect to get back to, and we see trends moving that way. Over the last 2 years, that borrowing cost has increased to as high as 6.25, 6 and almost 7. And today we have, a Treasury, a 5-year Treasury at 385. It is more stable and is expected to stay more stable than the volatility that we've experienced in the last 3 years. Corporate spreads are lower than they've been in a long time, and so we're seeing, and there's a lot of capital that's been raised. So we're seeing spreads in the 100 to 160 range, which nets you an all-in 5-year fixed rate for a stabilized asset of between 4.75% and 5.5%, and that's expected to stabilize. Finally, here's a graphic that shows on the debt side of U.S. capital markets. This is a graphic that shows all the different lenders and their increased activity in quoting property types. 2 years ago, banks were under a mandate to pull out of commercial real estate. They're back on. They're back in the market in a major way. All major life companies that invested in commercial real estate are expected in this year and the next year to continue to increase their allocations to commercial real estate. And then, of course, there's the government fund, the GSEs, Freddie Mac and Fannie Mae and HUD, who have larger amounts of capital to deploy in the space. Their budgets have gone up 20% from $70 billion to $88 billion. One thing I want to point out here too is office, which is a sector that's taken a hit on the valuation standpoint and a demand standpoint as a result of COVID. We're seeing a large, significant increase in the number of lenders that are willing to quote and see the value, the relative value here as the winners of that downturn are starting to emerge. Now I'll turn it over to Dave to talk about sales transaction themes.
Thanks, Trent. This is a great slide. The largest holders of capital are turning risk on. So what that means is the largest pools of capital largely paused between 2022 and 2023 during rate volatility and price discovery. And now that values have reset and debt markets are open, they're starting to re-enter the marketplace. So large investors deploy when pricing adjusts and liquidity returns, not when markets feel comfortable. That's the environment we're moving into right now. So for residential rental housing, this is especially important. Apartments are viewed globally as defensive, essential demand, reoccurring income, and resilient through cycles. And for Southeast U.S. markets specifically, capital flows, population, job growth. The region continues to attract people, companies, investment, which is why these markets are consistently overweight in institutional and private portfolios. Next slide. Yeah, so the CRE outperformance in buying below replacement costs, commercial real estate has historically delivered strong long-term returns because it combines income, appreciation, and inflation linkage. Unlike equities, you are investing in a tangible asset that produces real cash flow. And one of the most important points today is replacement cost. In many U.S. markets, existing multifamily properties can be purchased for less than it would cost to build them today. When prices fall below replacement costs, new deployment slows because it's not economically viable to build. That limits future supply and strengthens the position of existing owners. This creates a natural support level for values and improves long-term return potential, particularly in growth markets where construction costs remain high. Next slide. So market health. Market health and liquidity seems like all systems are go. This slide shows the mechanics of a healthy market are coming back into place. Capital flows are improving, lenders are active, institutions are allocating again, and debt pricing is more competitive. Compared with other investments, real estate offers income, dollar-denominated assets, and an inflation hedge. Bonds provide limited real return, and equities have higher volatility. So credit markets are functioning, more lenders are quoting deals, financing certainly improving, and which supports transaction activity and pricing stability. Fundamentals for rental housing remain solid. Housing is a necessity in many markets. Owning a home has become less affordable, which extends the renter life cycle and supports occupancy. So the key takeaway here would be when capital flows, credit availability, pricing transparency, and fundamentals align, transaction markets re-accelerate, and then alignment is happening right now. Before we wrap out for this audience in particular, your private investors, this is not about short-term market timing. It's about positioning capital in large, transparent market with strong legal protections, reoccurring income, and long-term demographic support. So U.S. multi-housing, particularly in the Southeast, sits at the intersection of population growth, job creation, housing affordability pressure, and deep capital market liquidity. that combination is why global and private capital continues to allocate in the space.
Because of these factors here that we pointed out at the beginning, these lagging, we're at the beginning. It's not a perfect market, but this is a great opportunity as these things go from lagging to accelerating. Because when they're accelerating, prices will be high again. The opportunity may be missed. And now we'll turn it over to Moore, who's going to discuss Israeli investor appetite.
Yeah, guys, let me just mention to emphasize a couple of points you guys made. So exactly what we're seeing in term, and I want to emphasize it. You said that, all in debt today is roughly 5.25 versus 6.5 just a year and a half ago. And we definitely see it, and it is super meaningful when you buy assets because prices haven't increased yet. And secondly, and I will also relate to it in my when I speak about office, is the fact that you have many more lenders today in the market willing to lend. So thank you guys, and we'll turn to you again when we speak about multifamily, and now I'll turn it to more.
So thank you, guys. I'm Morziv. I'm the head of international capital coverage, which means I'm covering the Israeli capital investing in real estate around the world, including the Israeli pension funds, institutionals, family offices, high net worth individuals. I will begin with a bit fun facts about JLL, and then we'll dive into how Israeli investors are investing, where, why, and some interesting data. So JLL, as of today, we are more than 110 employees around the world, operating in more than 80 countries. We are conducting almost $1 billion each business day of transactions around the world, listed in the New York Stock Exchange. Of course, we are part of the Fortune 500. Technology and innovation is not only a word in JLL. It's a way of thinking. It's a way how we operate. We have a dedicated department that including more than 3,000 employees that doing only innovation and tech for real estate called JLLT, including Spark, the VC that we are investing in startups, in PropTech startups, and our teams are implementing and developing services and tools that add value to our clients and empower our professionals around the world. We are the largest real estate research firm, covering more than 299 and 292 locations around the world. We have dedicated team in most of our locations, and we are covering many data cross-sector, cross-geography, again, as part of our value add to our clients. So about Israeli international investments. So when I've joined JLL 5 years ago to initiate the capital market in Israel. And when I started, I wanted to understand where is the Israeli capital position. So I started to conduct a research along with our great research team to understand our position and ranking. And since then, I'm doing it every year. I was very surprised to see these numbers. So Israel is the 7th largest investor in Europe, the 10th largest investor in the US. It's amazing numbers when you think of it, because Israeli capital are investing less than 30 years in real estate around the world outside of Israel. So it's not a very long time. That's one. And also, this ranking is even high. The real ranking is even higher, because when you are investing in, let's say, the US, you are opening an LLC. This LLC is an American LLC. So our data is not covering this because it's registered as an LLC, an American company, not an Israeli company. Same for the Israeli pension fund that investing mostly with GP, with local GPs. So the transactions are mostly registered under the local GPs. So we can't see this transaction as Israeli capital invested in investments. So the ranking is even higher, which is more amazing. So if you want to deep dive to how Israeli capital investing, so it's really interesting to see that Q3 2025 had the highest four-quarter volume since Q2 2020. The sentiment is very optimistic. Also, if we're looking forward to 2026, the investors are increasing the allocation to real estate. And if we are looking at the data of the check size for each deal, so we can see in 2018 and 2019, we can see the 73 million check size, and then it went to 21, 27, and 2025, it was the average check size of $34 million. It's equity, of course, and we need to have a quick reminder that it's not including the pension fund. The pension funds are usually investing between $60 to $80 million per deal. So this is a very interesting. Regarding geography, so it's not a surprise to see that the US and the UK consistently receive more than 50% of the Israeli capital. We can see more investment in Germany, in Poland, and other countries, but definitely the US and the UK is the highest volume of transactions. And regarding sectors, so you can see here two tables. One is the aggregate data from 2019 until 2025, and one is only for 2025. So from 2018, we can, and also in 2025, we can see industrial and logistic have a big portion in the portfolio. Again, not a big surprise. There is also companies that dedicated only, Israeli companies that dedicated only to industrial and logistics. We can see that if we see from 2018, we see the offices is still part of the portfolio. And in the 2025, we can see that hotels and hospitality took the second place. I would mention it's most of it's in Europe. You know, like names like Fatal, our client that is very active in this sector. And of course, the living and the multi-housing, which is a very interesting sector for investment for Israelis. It also includes the senior housing, assisted living, multi-housing, of course, single family houses, which has a lot of variance between into the sector. So it's very, very interesting. And that's all for now. If you have any questions, so there is a Q&A, if I'm not wrong, in the end of the webinar. And you can reach me on LinkedIn if you have any more questions. So thank you all.
Great, Mor. Thank you very much. I'm aware of the fact that Israel is number 10, obviously, in US real estate investments. It's always amazing to see it. And, you know, if you think about it versus the population here, it's even more amazing. It's probably maybe Singapore and Israel are probably the first ones. So thank you for that. I'll turn to Dave to speak about multifamily, multi-housing in the US.
Thanks, Eric. Trent, I think you were going to bring up some slides. And take the first one.
Okay, hello. This is U.S. Multifamily Capital Markets Overview. Very similar to the themes that we hit on for the overall market. Multifamily represents a very interesting opportunity in the coming years. The reasons for that are kind of outlined here in our multi-housing fundamentals. Each of these squares represents kind of the step-by-step process of of how there's going to be more transactions at probably excellent prices. First of all, in the last 3 years, we have a structural undersupply. We're 3.5 million dwelling unit shortage. There's a real rent-to-own dynamic that's in place that is pushing folks to rent versus home ownership. People are either staying at home, people are buying homes much later and renting a lot longer. So those are long-term structural tailwinds that are impeding home ownership. The other thing that's really moving forward is we had a large amount of deliveries. These are projects that were started in 2020, 2021, 2022. They delivered in 2023 and last year. Those deliveries peaked last year and are drying up. So while there might be very little rent growth as a result of all those deliveries and the other dynamics in the market, if history repeats itself, and we'll show that in a slide coming shortly, this is going to lead to rent growth increases. So those are the multi-housing fundamentals. As we talked about before, the other thing fueling this is there is a very large, significant amount of debt market liquidity. Freddie, Fannie, banks, life insurance companies, finance companies, all are very interested in putting out large amounts of, or allocating large amounts of resources and capital in the debt space, which will drive, and that cost is getting lower, which will drive transactions and drive returns.
Thanks, Trent. Here are some more key themes. So the core message overall here is U.S. multifamily is moving from a wait-and-see market into a reopening capital markets environment. Transaction activity is improving, pricing is stabilized, and the stage is being set for the next cycle. Liquidity is returning. Transaction volume reached $107 billion through Q3 2025, which is up 12% year over year. With Q3 closings meaningfully ahead of last year, the market is functioning again. Both buyers and lenders are active, and price discovery is happening. So pricing is steady even in a compressed yield environment because investors are underwriting long-term rent growth and focusing on durable cash flow. Multifamily, for example, behaves like income-producing instrument with built-in growth, especially as supply tightens. Valuations have reset more attractive entry points following cap rate expression. And then investors today are entering post-repricing levels rather than peak cycle pricing with improving forward conditions. So for international investors, U.S. multifamily remains one of the clearest combinations of rule of law, market scale, liquidity, and professional sponsorship, which is critical when allocating capital across borders.
This slide shows multifamily volume over the last 10 years, roughly $160 billion volume is the average. Obviously, in 2023 and 2024, we saw those volumes fall off. Last year, there is a pickup. The 2025 returns are not in, but it's close to 160 billion. So we're returning toward the average, and we expect it to increase. This is another one of our favorite slides. It's like the debt slide that shows you where we were on the cost of capital. This is a slide that shows where we are now, where we were before, and where we are now with regard to where cost of debt is, where rent growth was and is, what cap rates are both going in and exit. And you'll see that there's a relationship between volume of transactions between cap rates for multifamily sales and the U.S. Treasury. So as the Treasury goes up, there's a gap which shows that there's good liquidity here in the market. Today we have going in yields between 4.75 and 5.25 for going in cap rates. What's interesting is that the market perceives that there will be an increase in NOI, there'll be an increase in rents, and they're underwriting market exit cap rates at below the going in cap rates. So people are underwriting a 4.5 exit to a 5 exit on a 4.75 cap rate today. This is again pointing out that rent growth is expected over the next 2 or 3 years to increase, where it is over where it is now. And again, the Treasury is also expected to stay in a relative stable position. This shows the similarities between the Great Recession and the trough of the last 3 years and where we are relative to that and the opportunity. Right here, we're 27% off peak on valuations. And if you look at what happened in 2009 through 2011, where valuations went and how the market recovered, we're here. We're in a spot where we're expecting those valuations to increase.
Here, so long-term U.S. apartment supply peaked and expansion is slowing going into 26. So the core message here is the supply wave is a near-term story, and what matters more is what happens next. Deliveries slow sharply, and that typically restores pricing power. So supply expansion peak, you can see right here in 2024 at about 2.7%, and is projected to fall to around 1.2% on average from 26 to 29, so well below the long-term average. The pipeline is rolling over, and multifamily fundamentals are very sensitive to changes in new delivery volume. The setup for investors is straightforward. Less new supply plus conditioned household formation supports stronger occupancy and rent trajectory over time. In the Southeast specifically, long-term demand drivers like population inflows, job growth, and relative affordability have historically supported absorption. So a slowing national supply picture is constructive overall and can even be more meaningful in markets with durable inbound growth. I want to address also maybe some of the recent softness in the market, which has created some short-term pressure from heavy deliveries. This is exactly why the projected drop-off in expansion rates is important. This is literally the mechanism that tightens conditions again and sets us up for rent growth. Next slide. So you can see here, construction starts at a 14-year low, down 77% from the peak. The key takeaway here is that the key forward-looking indicator. Starts collapse first, and then rent growth usually follows that with a lag. And you can see here, construction starts are at a 14-year low, 77% down from the peak. Developers have pulled back sharply because financing is tighter and construction costs are higher. So starts today become deliveries tomorrow. This effectively caps future supply growth and sets us up for a more favorable balance between supply and demand. So for investors, this improves the odds of higher stabilized occupancy, better renewal spreads, and more predictable cash flows over the next cycle. We don't need aggressive rent assumptions. We simply need supply to normalize, and the data here shows supply is already starting to self-correct. History repeats itself. So this is a great slide, just highlighting what we believe with strong conviction is likely to happen in 2026 to 2028. So after late market cycle supply wave, the pullback in starts can create a multi-year undersupply period, historically a strong window for multifamily performance. This slide draws parallels between the 2010 to 2013 period when liquidity improved and supply conditions were favorable. That period produced really strong rent growth and strong multifamily investment outcomes if you deployed capital during that period. So the thesis here for 2026 to 2028 is similar. Supply growth slows, capital markets improve, and fundamentals reaccelerate as the market absorbs the final wave for deliveries. This is where, again, sponsor selection matters. Operators who can invest during a transitional market and hold through a tightening supply environment are positioned to capture that upswing. So the best multifamily vintages are often created right after the supply wave peaks, when the data is improving, but sentiment has not fully caught up.
All right.
Thank you.
Thank you very much. Thanks, Dave. I will wrap this up with an overview of the office sector. Let me share my screen. All right. Great. So before I dive in, I'll just be upfront. Office is probably the most controversial sector in the US real estate today. it got the most hit, and I'll explain why and what's happening today. Headlines today tend to focus on distress, declining values, structural challenges, and in many cases, these concerns are very, very real. What we're seeing on the ground is not, as always, by the way, it's not a single office market. It's a very fragmented one, obviously. Meaningful differences if you look at different locations, type of buildings, quality, tenants, etc. And my goal is just to give an overview, not to say what's good and or bad in office, but kind of like what we're looking at, how to evaluate investments in the office sectors, and what to look for. Maybe I'll start by saying, how did we get here, right? So first of all, what happened back in 2020, as we all remember, COVID, which really changed the dynamics. Employers and employees understood that work can still be done from home. You don't have to be at the office, and work was still done, and corporates functioned normally, basically, during this time, and understood that maybe we don't need an office. This was one. Secondly, we got into the market when it was a bit oversupplied back in 2019, beginning of 2020. The market was a bit, overconstructed, and those two things that happened together created the perfect storm. Fast forward 5 years, what do we see today? Those are headlines just from the past couple of weeks, but we've seen it in the past year or two, that companies are asking employees to go back to the office. So we see Amazon tells the workers to return to office 5 days a week. This was 2 weeks ago. Last week in Israel, Wix, a very large employer in Israel, orders employees back to office full time. And we also see that investors that didn't want to hear about office investments, and I'll get into it and see equity trends, they're starting to look at office again, start investing in it, and feel more comfortable. So let's see how this plays out. First of all, so if we're looking at net absorption, this is the chart. So net absorption is demand versus supply. So if what you see here, that since COVID, supply was larger than demand, so you see the negative absorption, and we see that it has changed in the last 2 quarters when actually demand is higher than supply. We also see that asking rents increased roughly 2% year over year, which is the strongest annual growth since COVID. So we're not seeing, you can't say that based on this chart you see a full recovery in the market, but you do see stabilization. And then you have to look at, certain markets, certain office quality types, etc., and we'll dive into it. But definitely we see that the trend changed, and it looks much more optimistic now than it was a year or two ago. So if we're looking at demand, so you have in office, like every sector, you have class A, B, C, depending on the location, depending on when the asset was built and how amenitized it is. What you see in the chart is leasing activity by class as a percentage of inventory, and you see that class A always overperformed, and basically because you have less inventory in class A, so the numbers will always be higher. But if you're looking at the trend in the last couple of years, you see that it's recovering is better than the other two classes. So we see the tenants are prioritizing quality buildings, looking into best-in-class buildings and also good locations. And the reason is that as we saw in the first slide, you're asking your employees to come back to the office. You want them to have a good office environment in a nice building with interesting amenities like, gym, restaurants, etc., in great locations, so that they're able to get there in public transportation, and the entire environment with what they can find in the street and in the area is nice and new and vibrant. So we see this flight to the better quality assets. Supply is also resetting and it's pretty dramatic. You can see here office construction pipeline and the peak that we got into right before COVID. And since then, construction decreased dramatically. And what you're seeing now is that actually this one doesn't even count for demolishing offices or converting offices into apartments. This is only new construction. So right now we're actually at a negative, new supply coming into the market, which is very, very interesting. So the overhang of oversupply is definitely being addressed, and it's very, very meaningful when you look forward to see how the market will look like. In terms of liquidity, liquidity is both the availability of equity and of debt. We saw this chart in multifamily. Here, this is the office investment activity. So what's the transaction volume per year? So you can see an example that in 2019, 1 year before the arrow that is signaling COVID, we were at the peak, $120 billion of transactions in 1 year. It dropped dramatically in 2020 after COVID to $50 billion, increased a bit, and then went down again in 2023 once interest rates rose, and it got to a very, very low levels historically of 30 billion a year. We see that transactions are picking up, and capital is re-entering the market, but again, it's going to selective office buildings in certain markets. It's not across the board, and this is why you see that it's not coming back to 2019, but still the trend is very positive. So I would summarize by reviewing the key considerations when you evaluate an office investment. This is what we're focusing on. So first of all, strong locations. You want to be in very good markets, in a great locations, as I mentioned. We're looking for in-place cash flow. We're looking also at buildings that are 85% plus leased. Why? Because those, maybe maybe we don't know where the best location is or the best building is, but the current tenants will tell us that if the building is very well leased and occupied, it's obviously a place that tenants choose to be in. So we're looking for a high occupancy. Post-COVID tenant validation, this is a very important one. You want to focus on buildings where you have tenants that actually signed the lease after COVID. This means that they saw what COVID did. They understood that, work can be done from home, but maybe it's not for them. And they validated it. They signed the lease after 2021. So office is very, very relevant for them. Another thing that we check, diversified tenant mix, always a good idea. Diversification in investments, it's the number one rule. You don't want to focus on specific industry that anything could happen to it. You want to see many types of tenants. Low risk business plans. We don't focus on, rents are going to increase, occupancy is going to increase. We're looking at the building right now, being very conservative, and see that still the investment makes sense and cash flows are going to be there. Compelling entry pricing. So obviously, usually it's below replacement cost. Now looking at deals, it's significantly below replacement cost. To build a new office building is between $300 to $600 a foot. We're looking now at deals that are $150 a foot, significantly below replacement cost. And lastly, positive yield spread, meaning that the going in cap rate today, 10% plus, is much higher than the debt, which is usually today's market, it's 6.25, 6.5. It's not often that you see this spread in such a large segment of commercial real estate. It happens every 15 years. The last time it happened was in 2008, and before that also maybe, I don't know, in the 90s. It's pretty rare. You see it today in office, and this is what we're looking for. The spread between the cap rate and the debt. If you scan this, you get to our WhatsApp if you want to get in touch with us, and I will turn to questions. So again, feel free to write it in the Q&A. I will stop sharing now. It allows me. All right. Cool. So first question, More, I think this one is for you. So we saw that Israeli has strong preference for the industrial sector. It was the chart that you showed, I remember it was much higher than other sectors. Any idea why?
Yeah, it's a very strong. It has a very strong demand sector. You see the e-commerce, you see everything, and also this there is you can build strategy upon industrial. You can take a very old industrial and logistics assets and to do a value add. But Israeli very like this asset class of value add. You can buy it from moms and pops, small one, together it is to portfolio, and then sell it to the big funds. So it's easy to build. The cost is also cost effective. So this is
Yeah.
niche that Israelis love.
Yeah, I agree. This is also something that we see a shift from, investing in, which multifamily really was the highest, the best sector, or the one with most demand for investments. And we also see it in our transactions, and transactions are getting larger. There is a lot of financing in industrial as well, so it makes it easy to do the transaction, and it's fairly attractive. So yeah, definitely a trend. Another question, Dave, and Trent, is for you. So you mentioned the oversupply in the multifamily market, and it's taming right now. How do you view it in terms of different geographies in the US, the oversupply, and how it's now becoming less oversupplied?
Yeah, I'll take that one. So the long-term run rate on supply in the U.S. is about 300,000 units per year. And back in what was it like beginning of 24? Pull the slide back up, but we were delivering about 180,000 units per quarter, which is about 2 times the amount of supply we need to deliver on an annual basis. So that was a moment in time, right? We're playing catch up. Overall, in a broad brush statement, the U.S. is structurally undersupplied by 3.5 million units. So at a normal run rate, that takes about 10 years to build that many units just to meet the implicit demand. But we built a bunch of apartments real fast, and now because of rising interest rates and rising construction costs, the new starts have dropped precipitously. So now we've gone from overbuilding to building the right amount to now we're way underbuilding. We're building or delivering about 30,000 units per quarter, which means we're only fulfilling about half the demand. So we need to actually build more units, but that's going to take time for cost and interest rates to normalize around that. So we're in a window right now where we're building out of new units, yet you have the same population growth and job growth in markets like the Southeast, for example, which attracts most of the jobs and most of the population growth. So those markets are really going to see outperformance in terms of rent growth over the next 2 years, 3 years, 4 years, because there's just more demand than there is supply coming online now.
And I'll add to that in the markets that saw the most construction and had the most investor interest, which were the Southeast, Southwest, what we call the Smile States, where there's population growth, there's job growth. Though that's where rental growth is also stagnated the most, where concessions and bad debt are currently, I would say, afflicting asset owners. In the Midwest, where less investment happened, we've already started to come out. But at the same point, there's absolutely almost zero new deliveries in the Midwest at this point, and we're starting to see that rent growth already start taking place. What we're showing in our slides about what we think rent growth is going to happen over the next 2 or 3 years is happening in the Midwest. So the Smile States are always going to be in high demand, and we haven't quite got to the point where we've worked all the way through the new deliveries, but that is an opportunity that we see moving forward. And then we look to the Midwest to see how, I mean, the Midwest has the highest rent growth in the country right now at close to 3.5%. So we expect the rest of the country to follow suit.
Excellent, thanks. A few more questions. So, and feel free to jump in. So, first of all, our office valuations actually getting better. I'll start, but guys, again, feel free to jump in. I'll start by saying that it is very, very, very building specific. Some of them are not, in areas that there is oversupply or there's not much demand for whatever reason, then no. But I could give an example that our first deal after COVID was roughly a year and a half ago. And yeah, we do see that for this specific building, the cap rate when we bought it, that we bought it at is now lower than what we had. So yeah, the valuations is going up, not dramatically. And there is also the availability of debt that is also helping here. So if you're buying now and you have much more debt available, and I'll let Trent to add to it, then it also helps valuation because now you get more offers for this, and there is actually a bid war, and so it is, yeah, we see valuations, but again, very, very depending on the specific building. Trent, anything to add?
Yeah, so lenders are office has always been one of the four major food groups of investments of institutional grade asset classes, and even though the last 4 years have been a downward spike in valuations, and even though as an asset class it's fallen out of favor, it still remains very important. And it's also a place where lenders can put out large equity checks or large debt checks. The real issue is and this kind of has already happened in the market, there are assets that are in demand, as Uri had pointed out, in the right markets with the right types of build out, the right type of demand drivers, and then there are commodity assets that are no longer are functionally obsolete, and we're seeing those assets be just taken out of the market. So lenders are starting to see this opportunity, and they are quoting, whereas 2 years ago we might start a meeting with a lender and they say that we want to lend in multifamily, we want to lend in all these different things, including alternatives, and we're risk off with regard to office.
Okay, yeah, that answers the next question. Are lenders preferring residential? So I guess you answered it, but if you want to add to it.
They still prefer residential, and we do expect credit to open up. Basically, they're really scrutinizing it more than maybe they said 5 years ago when it was a very hot asset class with all the metrics on the rise. But yes, they do prefer residential, but lenders want yield as well, and so they're looking at office as an opportunity to get in at the right basis with the right sponsor, with the right business plan. They're very interested in office. Multifamily will continue to be a high demand driver. The two major, or three, they're government based, but Freddie Mac, Fannie Mae, and HUD are that's public money that's put into the market to provide liquidity. So it'll always maintain an advantage with regard to lender interest and competition. But we are seeing office is coming back, and the relative value being recognized.
Okay, thank you. How will the future of interest rates impact investor appetite for floating rate versus fixed rate debt, as well as refinancing assumptions?
I'll take that, I guess. So floating rate debt was for 15 years was held low by government quantitative easing. Those days are over. It's probably not going to. I don't have a crystal ball, but there is no plans and no expectation for the government to start bringing short-term borrowing rates down to near zero as it was at the peak of the last 15 years. We are starting to see borrowers look at floating rate versus fixed because the near-term rates with the Fed are expected to come down over the next 2 years, but we're still seeing most folks do fixed rate 5-year commercial lending, because there is a feeling that things are going to get better and rates are going to get incrementally better. So let's take away the volatility issue with a floating rate. That's been the sentiment over the last 3 years, and put in short-term 3 to 5 year fixed rate debt so I can sleep at night, not knowing that my interest rate is going to change, but also have the opportunity to refinance or to sell when markets rebound. That was the sentiment 2-3 years ago, and we're now coming at the end of those 3-year fixed rate to 5-year fixed rates. We're seeing a lot of refinance opportunities because of it, but there is a reluctance to go long term, because there is a feeling that interest rates still have some room to run on down closer to that 3.5 versus the 4.25 where we are now on the Treasury, 10-year Treasury.
Thanks. And Dave, I think this is the last one. This one is for you. Secondary markets versus core markets in multifamily, and how they react right now.
Yeah, it's a very good question, and one that we can talk about in 2 parts, right? And in secondary markets, or markets that are more fringe in geography, you're going to get a greater percentage of your total return in the form of cash flow versus appreciation. So a lot of people view appreciation as speculative, whereas cash flow, the return, you're buying the asset and your cost of capital, and so you get positive leverage. It's a lot easier to predict your forward-looking cash flows on an asset. In most major markets or gateway cities, you might have a greater percentage of your total return weighted to appreciation rather than in-place cash flow. So while your cash flow might be smaller during the holding period, you're going to get an outsized return when you sell the asset or monetize the asset, because your growth rate is going to be much larger, in a major market. So it really depending on which one you value more. Do you value predictability in the cash flow, or do you value the ability for more appreciation over time, but that appreciation isn't guaranteed, and you got to time the market. So it's really, do you want to go for a larger return that's less predictable, or a smaller return that's more predictable, although you will get more income during your holding period in the secondary market, typically.
Okay, great. Thank you very much. This concludes our webinar. Guys, thank you so much. JLL, you've been a great partner for us for, I don't know, since we started, and we appreciate you taking the time, and we look forward to 2026. Thank you.
Thank you.
Thanks for having us.
Thank
Bye.
you.